Stock markets are places that we can invest for future consumption. The investment in the stock market essentially is not different from foreign exchange market, bond market, or simple commodity market in terms of the validity of the principles of economics. The most attractive side of the stock market is that it is dynamic, rapidly moving, and highly uncertain. The first question coming across the mind is that can we make profit by identifying the market trends correctly and acting at the right time? Let's approach these questions both in the short run and in the long run, and by bringing finance and economics into the analysis. First, let me introduce you a concept from finance, which is arbitrage. The arbitrage defines the investor's movement across markets for the profit purposes. The investor buys from cheap market and sells in the expensive market and get arbitrage profit. The investor also can gain arbitrage profit by buying cheap today and selling expensive tomorrow. Let's use demand theory in economics along with the arbitrage. According to demand theory, the price for the commodity increases as the demand goes up. Suppose now there is an arbitrage opportunity for any stock, which means that we can buy the stock cheap today and sell expensive tomorrow and earn arbitrage profit. Because investors seek profit and will want to buy the stock if there is arbitrage, the demand for the stock will increase and the price should rise according to demand theory. Therefore, the current price of the stock will increase until it reaches the price it is expected to take tomorrow. Therefore, the market will absorb arbitrage profit, implying that all profits that the investor will gain tomorrow will be random. Therefore, in the short run, the only factor affecting the profit is pure luck. Financial economist Mishkin states that the investor should not try to outguess the market by constantly buying and selling securities. This process does nothing but boost the income of the brokers who earn commissions on each trade. In the long run, things are not very different. Suppose you buy and hold the stock and sell at the 5th year. The investment gains will be dividends you get through time and the arbitrage. However, if there is arbitrage, the investors will bid up the price until there is none. Therefore, the market will absorb the arbitrage that you can make in the long run. From that perspective, the investment advisors are not better than the economists or other financial analysts and do not outperform them. And moreover, their success in the past do not imply the success in the future. The San Francisco Chronicle asked 8 analysts to pick 5 stocks at the beginning of the year and then compare the performance of their stock picks to those chosen by Jolly, an orangutan living at the Marine World in Vallejo, California. Consistent with the results found in the investment dashboard feature of the Wall Street Journal, Jolene beat the investment advisors as often as they beat her. Therefore, you can comfortably hire the orangutan for the investor advisor position. Is there a way to beat the market?
Trust me, everything's gonna be fine.
Maybe, not always, but if the time is the time that the market is not efficiently functioning, in the sense that it is not perfectly using the available information set, then there might be a way. Dr. Michael Burry in the movie Big Short, after reviewing the subprime mortgages, realized the growing risks in the subprime markets and bet against the market. When everyone was heavily investing in the mortgage-backed securities, and he beat the market. Is there any other way to beat the market except being in an extraordinary time like 2007? Can anyone using sophisticated computational techniques and computation power beat the market? Jim Simmons, who is an American mathematician and primarily focused on the geometry and topology of manifolds, and also once was recruited by the National Security Agency to break codes, actually achieved this. He founded the Renaissance Technologies hedge fund, where he used sophisticated computer-based models to predict changes in the financial assets. The fund earned over $100 billion since 1988. In sum, the beating market and earning extraordinary profit is not feasible if there are not market anomalies or unless we employ sophisticated financial models to catch the local market anomalies. Therefore, there is not easy cut for making profit in the market unless you are very lucky.